This question tests your understanding of the relationships among standard cost variances, and asks you to identify the factor that could not simultaneously produce three favorable variances. Favorable material quantity variance, MQV less material was used than the standard allows. Favorable direct labor efficiency variance, LEV fewer labor hours were required than the standard. Favorable fixed overhead volume variance, FOVV production exceeded the denominator, budgeted activity level, allowing fixed overhead to be spread over more units. Students should recognize that operational improvements, such as better materials, improved machinery, or stronger supervision, can reduce waste and labor time while increasing production capacity. In contrast, using lower-skilled workers generally reduces productivity, increases material waste, and requires more labor hours, making favorable efficiency variances unlikely. The key idea is to identify which alternative is inconsistent with favorable efficiency and volume performance. A. The purchase of higher quality materials. Incorrect. Higher quality materials often reduce defects and waste, leading to a favorable material quantity variance and favorable labor efficiency variance. Faster production may also contribute to higher output and a favorable fixed overhead volume variance. B. The use of lower-skilled workers. Correct. Lower-skilled workers typically require more labor hours, produce more material waste, and reduce production efficiency. These effects would likely create unfavorable, not favorable, material quantity and labor efficiency variances, and would not support a favorable fixed overhead volume variance. C. The purchase of more efficient machinery. Incorrect. Improved machinery can reduce labor hours, minimize material waste, and increase production capacity, making all three favorable variances possible. D. An increase in production supervision. Incorrect. Better supervision can improve production efficiency, reduce waste, and increase output, potentially leading to all three favorable variances. Correct answer. B. The use of lower-skilled workers. Lower-skilled workers generally decrease production efficiency rather than improve it, making it highly unlikely that their use would simultaneously produce a favorable material quantity variance, a favorable labor efficiency variance, and a favorable fixed overhead volume variance. This question examines the interpretation of a favorable direct labor price, rate, variance, and the importance of looking beyond the variance itself. The direct labor price variance measures the difference between the actual wage rate paid and the standard wage rate. A favorable labor price variance means that the company paid a lower wage rate than expected. Although this appears beneficial, management accountants emphasize that a favorable variance is not always good. For example, hiring lower-skilled workers may reduce wage costs but increase production time, material waste, product defects, customer complaints, or warranty costs. These negative effects may create larger unfavorable variances elsewhere in the value chain, outweighing the initial labor savings. Therefore, managers should investigate the underlying causes of favorable variances, rather than assuming they improve overall organizational performance. The circumstances giving rise to the favorable variance will not continue in the future. Incorrect. While this may be a concern, it is not the most significant issue from a management accounting perspective. B. The production manager may not be using human resources as efficiently as possible. Incorrect. A labor price variance relates to wage rates, whereas labor efficiency concerns hours worked and is measured separately. C. The cause of the favorable variance may result in other larger unfavorable variances in the value chain. Correct. Lower labor costs may result from hiring less skilled workers or reducing training, which can increase material waste, rework, poor quality, warranty claims, and customer dissatisfaction. The overall business impact may therefore be negative despite the favorable labor price variance. D. Actual production is less than budgeted production. Incorrect. Production volume affects volume and efficiency variances, not the labor price variance. Correct answer, C. The cause of the favorable variance may result in other larger unfavorable variances in the value chain. Managers should evaluate the overall impact on the value chain, recognizing that a favorable labor price variance may simply shift costs to other areas and reduce total organizational performance. This question tests your understanding of direct labor variance analysis under a standard costing and flexible budgeting system. In standard costing, managers compare actual labor costs with standard labor costs to evaluate performance and identify the causes of cost differences. The total direct labor variance, also called the total budget variance for direct labor, is the difference between actual direct labor cost and the standard direct labor cost allowed for actual production. To provide more useful information for management, this total variance is divided into two components. 1. Direct labor rate variance. Price variance measures the effect of paying workers a wage rate different from the standard rate. 2. Direct labor efficiency variance. Measures the effect of using more or fewer labor hours than the standard allows for the actual output. These two variances together explain the total direct labor variance and help management determine whether differences arise from labor rates or labor productivity. A direct labor rate variance and direct labor efficiency variance. Correct. The total direct labor variance is always decomposed into these two standard components, a rate variance and an efficiency variance. B. Direct labor cost variance and direct labor volume variance. Incorrect. Labor cost variance is the total variance itself, and labor volume variance is not a standard decomposition for direct labor. C. Direct labor rate variance and direct labor volume variance. Incorrect. Labor volume variance is not one of the two standard direct labor variances. D. Direct labor cost variance and direct labor efficiency variance. Incorrect. The direct labor cost variance is the total variance, not one of its components. Correct answer, A. Direct labor rate variance and direct labor efficiency variance. Under a standard costing system, the total direct labor budget variance is analyzed into 1. The direct labor rate variance, reflecting wage rate differences, and 2. The direct labor efficiency variance, reflecting differences in labor hours used. These two variances together explain why actual labor cost differs from the standard cost.